SoFi stock is trading right now at $7.14, up 1.85% on the day as trading volume builds across major exchanges. Most people looking at this ticker see a fintech company that got swept up in the broader regional banking panic, lost its momentum, and has spent the last couple of years trying to prove it is more than just a place where fresh college graduates refinance their student loans. That is the consensus narrative. That is what retail forums and financial cable networks talk about every single afternoon. But if you look under the hood at the actual clearing data and institutional position shifts from the last 48 hours, a completely different reality starts to emerge. While the general market treats SoFi as a speculative tech play that gets hammered whenever interest rates stay higher for longer, institutional accounts have quietly been using these exact price dips to build massive positions in SoFi active investing accounts and clearing structures. They are not buying SoFi stock because they expect student loan forgiveness to suddenly disappear, and they are not buying it because they think young professionals are suddenly going to rush out to open traditional savings accounts. They are buying it because SoFi is transforming into a full-stack banking infrastructure provider that makes money whether the market goes up, down, or completely sideways. Let us bridge the gap between what the market expects and what is actually happening on the ground. The common belief is that SoFi is trapped by high interest rates. When the Federal Reserve keeps interest rates elevated, the logic goes loan origination slows down, consumers stop refinancing their personal debt, and credit default rates start ticking upward. That sounds reasonable on the surface. If you glance at a surface-level headline about any digital lending platform, you'd probably agree with that assessment and move on to another ticker. But that line of thinking completely ignores how SoFi has restructured its underlying capital base over the last 8 quarters. When SoFi secured its national charter, it changed the fundamental physics of its business model. Instead of relying on expensive third-party credit lines or warehouse financing to fund its loans, which is what ruined so many other fintech outfits during the rate-hiking cycle, SoFi turned its user base into a massive source of low-cost deposits. Every time someone opens a high-yield savings account or uses SoFi Invest to buy fractional shares, SoFi gets access to sticky, low-cost capital. They pay a competitive yield to the consumer, sure, but they turn right around and deploy those funds into high-margin personal loans and credit products. The net interest margin they extract from that dynamic is vastly superior to what standard regional banks are generating right now. To really get a grip on why SoFi stock is moving the way it is today, we have to talk about the short-term trading dynamics and institutional volume flows. Over the last several sessions, we've seen a noticeable divergence between how retail traders are interacting with the stock and how smart money accounts are positioning themselves. Retail traders tend to react to headlines. If there's a headline about consumer debt reaching all-time highs, retail sells off SoFi stock. If there's a headline about mortgage rates ticking up, retail sells again. But if you look at the options market and dark pool order flow for SoFi stock, institutional investors are taking the exact opposite side of those trades. They are selling put options below the current price floor to collect premium while simultaneously sweeping up block orders of shares every time the price touches lower valuation bands. Why? Because from an institutional perspective, SoFi is no longer priced like a fast-growing tech firm, it's priced like a standard bank, yet it's growing its fee-based revenue like a software company. Look at the tech platform segment, specifically Galileo and Technisys. This is the section of the business that most short-term traders ignore because it doesn't generate the flashy consumer-facing headlines that show up on social media feeds. Galileo provides the underlying processing power and API infrastructure for dozens of other fintech applications, digital wallets, and neobanks across North and South America. Every time someone uses a card issued by one of these partner platforms, Galileo collects a small transaction fee. It's a classic toll booth revenue model. Technisys adds multi-core cloud banking software to that package, allowing traditional financial institutions to modernize their core technology without having to build everything from scratch. When you combine Galileo and Technisys, SoFi is not just competing against retail brokerages like Robinhood stock trading or platforms like Interactive Brokers Trading. SoFi is selling the actual underlying pipes that power the broader ecosystem. As more traditional banks realize their legacy mainframe systems can't keep up with real-time settlement demand, they are forced to outsource their tech stack to platforms like Galileo. That creates recurring, high-margin revenue that has almost zero correlation with interest rate fluctuations or consumer credit defaults. Comment below how many shares of SoFi stock you currently hold in your portfolio, and let me know if you're holding it for short-term swing gains or as a long-term position in your individual brokerage account. Understanding where SoFi stands today requires taking a quick look at where this company came from and how its foundational business model operates. Founded back in 2011 as social finance, the original concept was simple: create peer-to-peer lending syndicates to help elite university alumni fund student loans for current students at lower rates than traditional banks offered. Over time, that initial niche morphed into a full-scale direct-to-consumer financial app. Today, the consumer-facing business operates across three core pillars: lending, financial services, and technology infrastructure. The lending division handles student loan refinancing, personal loans, and home mortgages. The financial services division houses SoFi Money, SoFi Invest, SoFi Credit Card, and Relay, which is their internal credit monitoring and financial planning tool. In the early days, lending represented nearly all of the firm's revenue, which made the company incredibly vulnerable to changes in credit cycles and regulatory decisions regarding federal student loan payments. But over the past 4 years, management made a deliberate, capital-intensive push to expand the financial services and tech platform segments so that non-lending revenue would eventually carry the weight of the company. That pivot wasn't cheap. It required massive spending on user acquisition, platform integration, and marketing efforts, including long-term stadium naming rights. It also meant navigating a brutal macro environment where student loan payments were paused for years, shutting off one of their primary revenue spigots. Most financial startups would have folded or been acquired at a massive discount under that kind of pressure. Instead, SoFi pushed through the bank charter acquisition, integrated its tech assets, and systematically scaled its member base. Every quarter, they have managed to add hundreds of thousands of new members to the ecosystem. The core strategic idea here is cross-buying. If SoFi can acquire a user cheaply through a basic high-yield checking account or by offering online investment tools, they can gradually cross-sell that same user a credit card, a mortgage, or a wealth management service over the next 5 to 10 years. The cost to acquire that customer is paid up front, but the lifetime value of that customer expands exponentially as they move through different stages of their financial life. When you evaluate SoFi against the broader landscape of modern investment help platforms and digital brokerages, the positioning becomes even more interesting. You have platforms like Robinhood Investments focusing heavily on active retail traders, options volume, and Robinhood crypto features. You have Interactive Brokers platform catering to institutional accounts, professional day traders, and high-frequency international operations where Interactive Brokers fees and advanced order routing are the main selling points. You have Schwab Intelligent Portfolios and Fidelity Wealth Management catering to traditional wealth preservation, retirement planning through Fidelity IRAs, and long-term mutual fund asset allocation. SoFi Invest sits right in the middle of this spectrum, targeting the upwardly mobile demographic that wants a single, unified interface for everything. They offer self-investing features, fractional share access, automated portfolios similar to an intelligent portfolio setup, and high-interest cash management under one roof. They are not trying to beat Interactive Brokers on execution speed or advanced charting, and they are not trying to match Fidelity Brokerage on sheer scale of assets under management yet. They are building a closed-loop environment where a young professional gets their paycheck deposited, automatically allocates money to an ETF portfolio, pays their credit card bill, and monitors their personal credit score without ever leaving the application. Now, let's look forward at what lies ahead for SoFi stock over the next several quarters, because this is where the gap between expectation and reality will ultimately decide the stock's price direction. The market narrative assumes that as credit default rates across the broader economy climb, SoFi's personal loan portfolio will suffer significant write-downs. Skeptics point to the high volume of personal loans sitting on SoFi's balance sheet and argue that any prolonged economic slowdown will eat away at their capital reserves. That's the fear driving the bear case. But the reality of SoFi's borrower profile paints a very different picture. The average income of a SoFi personal loan borrower is well above the national average, often exceeding $160,000 annually with high credit scores to match. These are not subprime borrowers taking out high-interest payday loans. These are high-earning individuals consolidating high-interest credit card debt or financing major home improvements. Even during periods of macro stress, this demographic